All right, let's talk tax audits. If you're a CA or a business owner, you know the drill. With Form 3CD, the devil is absolutely in the details. Today, we're zeroing in on two of the most critical parts, clauses 9 and 10. Honestly, getting these right is non-negotiable. So we're going to use the ICAI's latest 2025 guidance note as our map to navigate exactly what you need to know.
So here's what we're going to cover. We'll kick things off with the basics of audit reporting, then we'll dive straight into the nitty-gritty of Clause 9 on partner details, and then Clause 10, which is all about the nature of the business. From there, we'll get super practical, talking about how to report changes and, crucially, how to verify them. And we'll wrap up by looking at the key pitfalls you really want to avoid. Let's get right into it.
First things first, let's just set the stage a little. Why is this form such a big deal? Well, at its very core, the whole tax audit process, and especially Form 3CD, it's all built on a foundation of trust. The tax authorities are really relying on the diligence and the professionalism of chartered accountants to give them a true and fair view of a business. I want you to think of Form 3CD as the absolute backbone of the entire audit. This isn't just another piece of paperwork to fill out. It's a formal, factual statement you're making to the tax department. Every single detail on there counts, and precision isn't just nice to have, it's essential if you want to meet your professional obligations.
Okay, time for our first deep dive. Clause 9. This clause is all about identifying the key players. We're talking about the partners or members in entities like firms, LLPs, or even an association of persons. It's about who's who in the zoo.
Now, the clause itself seems pretty direct, right? It says you have to list the names of all the partners or members, and, this is just as important, their profit-sharing ratios. It sounds simple on the surface, but as you're about to see, the nuance here is absolutely critical. So to break it down, what do you actually have to report? You need their full names, no abbreviations, and their profit-sharing percentage. Now, here's a key point from the guidance note. This also includes the loss-sharing ratio. Why? Because a loss is really just a negative profit. You also have to make sure you detail any changes that happen during the year, and we'll get to exactly how to do that in just a moment. And here's a massive point of confusion that trips a lot of people up. Let's be crystal clear on this, because Para 21.1 of the guidance note spells it out. The profit-sharing ratio is only for distributing the net profits or losses of the firm. It has absolutely nothing to do with any remuneration paid to partners like salary, bonuses, or interest. Mixing these two up is a classic and very avoidable mistake. All right, let's shift gears now and move on to Clause 10. This one's all about describing, correctly and concisely, what the business actually does. You can think of it as the first impression that the tax authorities get of the company's day-to-day operations. So the clause requires you to report the nature of every single business or profession the company was involved in during that year. This is important. If your client has multiple, distinct business lines, you can't just lump them all together. Each one needs to be stated clearly. Now, the key phrase from the guidance here is principal line. The goal is not to write a novel about every single thing the company does. It's about being clear and concise. You're just trying to identify the main category for each business activity. Think of it like you're writing the headline, not the whole article. So, what does a principal line actually look like in practice? Well, it means using these kinds of broad but descriptive categories. Are they primarily a manufacturer, a trader? Do they work as a commission agent? Or are they a service provider, maybe in tech or consulting? Or a professional service like legal or medical? That's the level of classification you're aiming for. Okay, so we've covered the what. Now let's shift to the how. We're going to get practical here and look at the actual steps for reporting changes in a partnership, and just as importantly, how you, as the auditor, have to verify all this information for Clause 9. Let's imagine a super common scenario. You're auditing a firm, and halfway through the financial year, they bring a new partner on board. How do you go about correctly disclosing that change in Form 3CD? Well, Clause 9b specifically requires you to detail any change in the partnership. And honestly, the best practice is to use a clear, simple table just like this one. You state the partner's name, the exact date the change took effect, and what their new profit-sharing ratio is. This creates a clean, unambiguous record for the tax authorities to review. Okay, so the client gives you the details. Your job's done, right? Not even close. This is where your professional due diligence really kicks in. How do you verify this information? What are the specific documents you need to get your hands on to back this up?
Luckily for us, Para 21.3 of the guidance note gives a really clear four-step process. First, you examine the original partnership deed and any amendments. Second, you check official filings, like documents filed with the registrar of firms. Third, you review the internal meeting minutes where the change was officially recorded. And finally, and this is so important, you get certified copies of all of these relevant documents for your working papers. That documentation is your proof of due diligence.
All right, let's get to our final section, the key pitfalls. Knowing the common mistakes and how to handle some of these tricky situations, well, it can save you and your client a world of headaches down the line.
So here's a tricky one for you. You're auditing an association of persons, or an AOP, but their main agreement is really vague about the profit-sharing ratios. It's not clearly spelled out. What do you put in the form? Do you just take a guess?
The answer, straight from Para 21.5, is an absolute no. You never ever guess. If the shares are genuinely indeterminate or unknown, your professional responsibility is to explicitly state that in your report. The golden rule here is transparency trumps assumption every single time.
Let's tackle one more common question, this time for Clause 10. Imagine you're auditing a big retailer, a company that sells thousands and thousands of different products. Does nature of business mean you have to list every category? You know, electronics, apparel, groceries. Where do you even begin to draw the line?
And the answer is a definite no. Remember that phrase we talked about, the principal line? Para 22.1 is very clear. For a retailer, the principal line is simply trading or retail. You are not expected to provide their entire product catalog. The whole point is to be accurate, yes, but also to be concise. So as we've seen, getting these clauses right really comes down to paying attention to the details. In the ICAI's guidance note, it's not just some helpful document you can glance at. It's really the essential tool, your playbook, that you need to get this job done right and, importantly, with confidence.
So I'll leave you with one final question to think about. Go beyond just filling in the boxes on the form for a second and ask yourself this. Is my documentation, my working papers that Para 21.4 talks about, is it robust enough to defend every single detail I've reported? Because when scrutiny comes, and it can, that documentation is your best and, frankly, your only defense.